Hi, I'm Rick Kaler. Thanks for joining me. On and off again tariffs, wars that drag on without resolution, political gridlock making it nearly impossible to know what policy will look like a year from now. And the most recent addition to the mix, concerns about state capitalism. My nervous system interprets all of this as danger, and I find myself bracing for the economic worst. Yet here we are with the U.S. markets near all-time highs. Why isn't the stock market crashing with all the bad news? Wall Street calls this climbing the wall of worry. Stocks often rise in spite of, or perhaps even because of, uncertainty. Today's market euphoria is probably fueled more by momentum, liquidity, and the concentration of returns in a handful of large technology companies. But even so, state capitalism is a possible trend worth watching because it can shape what future returns look like. And this is important. As I clarified in a previous video, this is not socialism, which eliminates markets. State capitalism leaves markets intact, but overlays them with significant government influence, which can affect market performance. It's an important distinction. To see how this is played out, I got curious, and I used indexes from MSCI Inc. to compare 10-year equity results to July 31st, 2025. And this is net of withholding taxes and dividends included. And this was for the U.S. and 4 countries widely seen as practicing versions of state capitalism. And here's what I found. In the United States had a 12.5% return during that 10-year period of time and had volatility of 16%, meaning it could fluctuate that much. 16% above, 16% under. Norway, which is oil rich and has a lot of state ownership, strong governmental interference, you could call it, was up 5.9%, which is about half of that, and had a volatility of 22%, which, when I say half of that, I mean half of what the U.S. did. And of course, the volatility was about 40% higher. Singapore had a 6.5% return with volatility of 18.5%. Saudi Arabia, which has strategic state guidance, was up 6% a year, volatility 18.5%. China was up just under 4% a year with volatility of 24%, almost 50% more than the U.S. So when you look at all this, the United States really crushed it. Norway and Singapore, with their mix of state ownership and strong governance, delivered mid-single-digit returns. China, where government influence and weak investor protections weighed heavily, produced the lowest results. All of these markets gave lower returns for higher volatility. In investing, that's a lose-lose. Now, does this suggest that investors should avoid markets under state control? And to that, I would say not really. They are still appropriate as a modest part of a global portfolio. While history shows that state influence mutes returns, and significantly so, and increases volatility, again, significantly, the evidence doesn't support a belief that investing only in free markets is going to supercharge returns or help reduce risk in a portfolio, especially from a diversification standpoint. What may be more important for your long-term financial health is to manage anxiety around the headlines than letting worry dictate your financial decisions. Fear-inducing news might lead a panicked part of you to warn, sell now, protect yourself before a crash. We're becoming a state capitalistic market. Another part might say, well, stay invested. You don't want to miss the upside. You know, the market's at an all-time high. Maybe it's going to go higher. Both of these parts, as polarized as they are, trying to help with good intention. Both carry emotional truth, and both are shaped not only by today's conditions, but by old experiences, often of scarcity or loss or distrust. What helps is slowing down enough to notice which part of you is driving the anxiety. Identifying what money scripts that it holds and are probably rooted in the past. And then compassionately acknowledging that it's fear and updating it with some new information. So here are the guardrails that I suggest to clients. Do not invest the equity portion of your portfolio all in the U.S. That's never been a good idea, even when we were embraced capitalism. Even with us moving towards state capitalism, and I would say, you know, especially so, consider aligning your allocation to U.S. stocks with their share of the global market, which is currently around 55%. That's something I would have done anyway in the past. It's crucial that you do it now. You could argue, well, maybe with moving towards state capitalism, it should be less than that. And that could be a reasonable argument to explore. Should it be 50 or 45? Regardless, even if you go with the 55% weighting to the U.S., at least 45% that needs to be invested in global markets, heavily weighted toward developed countries with free markets. And you want to maintain some diversification with exposure to state-guided markets like China or Norway. And they'll be minimized according to their capital market weight. In other words, they don't, as a percentage, make up a lot of the U.S. The global markets. And you can argue that they make up less because their returns are more muted, right? You pay less for those. Then when anxiety spikes with the next headline, the next acquisition, revisit your written investment policy to help you stay on track. Feeling anxious about alarming economic news is not irrational. It's very rational. History suggests that it's a pretty good mirror of how those markets behave. Our task as investors is to notice the parts inside us that panic. And we need to respect those parts, not shame them, not try to make them wrong, not try to get rid of them, not try to mute them, but respect them. And then lead them to clarity, which means we got to look at our confirmation biases. And we've got to be open to accepting facts and accepting truth, and not facts and truth as parts of us want to make it or manufacture it, what is actually there. And in doing so, we'll protect our portfolios from swinging with every headline. And that's really important today. Thanks for listening.